Hey trader, Steven Kwitzel here. It's tradersplan.com. It's Tuesday morning. We're looking at about an hour before the market opens. A lot of green on the screen, and that's very positive, right? It looking like the Dow futures are up around 4% as I record this. Of course, yesterday the Dow swung 1,000 points from negative to positive, back to negative by the time I was done with the 10-minute video. So just because you see green on the screen doesn't mean you need to go out there and buy with abandonment. It means you need to have a plan. So we're going to talk about a plan. And today, I want to do something that's a little different. I want to look at the market real quick, but I spent extensive time kind of, thinking and trying to find stocks that I think are good stay-at-home stocks, right? Companies like Amazon, Domino's Pizza, companies that have said they're hiring due to everything that's going on. So we're going to kind of look at that. We're going to look at a different list of stocks today with potential entry and exit strategies, and just kind of go from there. So let's start with the Nasdaq. I'm just going to continue to watch this 5-day moving average because we got rejected twice. Yesterday, the Nasdaq hit new lows. Almost finished the day positive, kind of reversed off the lows. So, if this is kind of a little double bottom and, we don't take a new low today and it bounces above the 5-day moving average, I would consider that pretty bullish. So we're just going to have to kind of keep an eye on this right now. I mean, even though there's green on the screen this morning, you have to say this is a bad downtrend, and you don't know when it's going to end. But there are some stocks holding up, so we're going to take a look at that, kind of, give you some ideas. And I have a special criteria for this list of ideas. Okay, so here's the criteria. So one, the criteria that made this watch list that I'm about to cover has to, be good at stay-home stocks in theory, meaning people should utilize these companies, right? The company, not stock. People should use the companies, during a time of crisis, during a time of stay-at-home. Everything from ordering pizza to ordering stuff on Amazon to Zoom video, right? Things that just kind of seem like a no-brainer, right? Now, that's theory. There are a lot of companies that should do well, but still look very ugly with the overall market. So I'm going to add an extra filter. I'm going to say, okay, not only are these stocks supposed to be good in theory, they're going to hold up. They should be holding up relative strength. That means they're holding up way better than the market. All these stocks, are looking pretty strong, except for maybe one. We'll talk about that. But let's kind of go through these. Now, the downside is 2 of these are completely gone. They're long gone. They're extended. Zoom video, which I think most of us have probably, heard or thought about this, right? Zoom conferencing. A lot of schools are going to start going online. A lot of companies, creating Zoom accounts. So if you get an opportunity to buy this on a pullback, this is very extended. This is probably going to ride the 5-day moving average, I would assume, for a little bit. Let me look real quick. This stock is down just a little bit pre-market, down about 2.5%. So that's hardly much given the fact that it was up 22% yesterday. So if this stock kind of takes a breather and pauses, if it gets close to the 5-day moving average, I would say that it is worth taking a tiny position because I think this is just one of those companies. I don't think this is an exhaustion. I think this is just one of those companies that could go absolutely parabolic. But I think it would be dumb right now to try to chase this right here. So, let it pull back, let it pause, let it kiss a moving average, and at that point in time, you can consider it. Teladoc Health, provides on-demand healthcare services for over 3,000 certificate, 3,000 physicians. Again, I think this one is a little bit of extended. This was up 18% yesterday. It's up 5% pre-market. This thing's going to go. So, these top 2 stocks I'm talking about probably need to take a pause, a breather, or some kind of a pullback, and we're just not there yet. Now, Everbridge, this is a stock that has shown a tremendous, relative strength. They help companies go online. They do a lot of things. But look at this relative strength line. I mean, it's outperforming the S&P 500 when the S&P 500, the black line, started declining. This thing never even broke its 50-day moving average. So, I think right now you really have to assume when you buy stocks, you have to assume a wider stop than you probably normally are comfortable with. So if you have to assume a wider stop, you take a smaller position. Okay, so I repeat that. So if you have to take a 20%, if you have to take a 20% stop loss, that's totally fine, but you need to take half the normal position. So it's the equivalent of taking a 10% stop loss. So with this one, I think if you can get this within 10% of the 50-day moving average, I think that's an excellent entry. And then you just, put a stop right under the 50-day moving average. Okay. Domino's Pizza. This one was outside of these two giant stocks. This one did really, really well yesterday. This was up almost 8% on a day where the market was flat to down. Nasdaq was down 0.25%. S&P was up down 1% in change. And what's interesting is the Nasdaq is holding up better because a lot of the tech stocks, like Amazon, Netflix, these are companies that people are going. These are stay-at-home stocks and that are such a big weighting. They're probably not going to be hit as hard. Plus, a lot of the bigger tech stocks, a lot of these companies can still work from home. They can still manage data centers. But, this is a stock that is really interesting, and I really like Domino's. Don't let the price per share fool you, because it doesn't matter if it's a $3 stock or a $323 stock. A 10% move is a 10% move, and it doesn't matter if it comes from a $3 stock or a $300 stock. You're going to make the same amount, okay? It's an illusion to think that you're going to make more off a lower price stock. But here's what's really interesting. This stock gapped up huge, 25%, right when the market started to peak. See this black line? That's the S&P 500. And then it just absolutely sold off, filled the gap, touched the 200-day moving average. But even when it was pulling back, it was still beating the market. And now it's just kind of holding steady, holding firm. With this one, it's just kind of the way it's acting. I think this is going to absolutely take off. This has been consolidating for 2+ years, about a year and a half. That's about an 18-month consolidation right there. And then it broke out and it came back and it tested the top of that breakout zone. Okay, that's a buy. So with something like Domino's, I haven't looked at where it's at before the market opens, but with this one, I think you go ahead and take a stab at it and just put a 10% stop loss. Or if you want to put, probably the safest place to put a stop is way down here at the 200-day moving average. Right now it's 17% below that level, so you would need to take a half position, and that would be the equivalent to an 8.5% loss. Again, it's all about managing your risk. We're not trying to back up the truck and buy shares, but this chart is looking incredibly well. I don't know if you've ever heard the longer the base, the higher in space. That was something an old consultant of mine, a mentor of mine, taught me, and I'll never forget it. When a stock breaks out of a long base that's going, 12 to 36 months, there is a reason for it, right? There's a reason where it finally breaks out. And the fact that it's holding up, I think the stock could make another run, and I think you want to hold it for a while. Try to, right? Put it as a safe. Put the stop in a safe place, right? DocuSign. This is the online, e-signature, right? I have to sign these all the time. I have a virtual company. I work from home. I sign these, electronic signatures all the time. Especially now, banks are going to be using these even now more than ever, right? Mortgage companies, everything. It's probably going to DocuSign, just like, Zoom. So this has done really well. Even though it has pulled back, it's now back above the 50-day moving average. So, in my opinion, I think this is very volatile, but you have to also be fair. So is the market, but it broke out of here. If it pops today, I don't know what's looking at pre-market, just put a stop under 80. Right, just check it out. Put a stop under 80 because this thing could just keep running. Okay. Amazon. Oh, I did forget to add Netflix to the list. I'm going to add Netflix to the list, so excuse me. So now we got Amazon, right? I think this goes without saying. I think Amazon has such a moat around it, and I'm going to kind of stretch this a little bit. It had a weekly reversal pattern last week, right there, weekly reversal pattern. So you can buy it right now. It came up, it got rejected at the 50-day moving average twice, but it kind of held. A lot of times this happens, so that's a different technical lesson. But when it gets rejected, but it doesn't fail, right? It tried to close below the 5, below the 20, below the 200, and it reversed up. It's probably going to break through today. But either way, with this one, I think this is one of those stocks where you want to take, you can buy it now, you want to take a smaller position than usual, because I think instead of having a 10% stop loss, I think you want to have it in the safest place possible, all the way down here, which is probably about 16% away. So I think it's best to take a half position, and that way you're only risking 8%. Or 0.5% of your overall portfolio. That's another lesson as well. But again, we're just kind of sticking our toe in the water here. Chewy. I believe Chewy is the pet online retailer. I think most of the shares are actually owned by PetSmart. But this really surged off the bottom, and that's the only thing I'm a little bit hesitant, is because it already, went from 20 to 35. I mean, this thing already went up 50% easy, but now it's holding this breakout zone. The negative to this stock is it does report in 9 days, okay? So, that could be good, that could be bad, but right now I'm probably not going to hold anything this volatile through earnings. I would let this might keep going, but I would consider seeing if it can consolidate for a couple more days, because a lot of times this needs a breather. When it makes a big move, it needs a breather. If you had to have it right now, just put a stop under Monday's, today's Tuesday, put a stop under Monday's candle, right? Because if it falls below it, the move is over anyways, right? You don't want to give it the opportunity to come all the way back. Touch that and then go up. That's a wide stop loss, right? Just put a stop. Sometimes when you're not sure, should I buy it, should I not, right? When in doubt, just put a stop under the previous day's candle. That way, if the trend keeps going, you're good. If it decides to whipsaw, shake you out, you're done, okay? We'll go back to Netflix. I think this, chart looks a lot like Amazon, right? Because it's also been consolidating for a year and a half. It almost completed a weekly reversal pattern, right? But it didn't close positive, but dang, that's close. Was up 8% yesterday, did very, very well. So again, don't let the price per share fool you. I think a lot of these stocks can really come out of here, and they can come out strong, stronger than ever. So with this, I would say that you could wait to see if it pulls back. It's really tough because, the market is now rallying off the low. So this could continue. So again, if you have to use a wider stop, maybe with this one, you're 12% above, 11% above the 200-day moving average, maybe you raise it to just under it, and just take a smaller position. Again, it's okay to take I think it's better to take smaller positions with wider stops than a few positions with tight stops, because we could chop around at the bottom. Two more Nintendo. Nintendo, this one isn't as technically strong, so this is probably my least favorite on the list, but it did complete a weekly reversal pattern last week, okay? So, and I've been seeing, look, it's already, one reason why I like it is, yes, it did sell off, but it's already above the 20-day moving average. It's above the 5-day moving average, where the market is not even close to the 20-day moving average. So all of a sudden it's showing some relative strength. It could pop up, hit the 50-day moving average, get rejected, find support, get wedged in between, and then pop out of there. So if you like this, I would just see where it opens, and then you could easily put a stop under right here, because if it falls below here, it trades over, right? This probably has the best risk reward entry, just because of where you can potentially put the stop at. You can just put it under yesterday's low. Cloudflare, this was a stock that was showing a ton of relative strength. This was completely bucking the trend when the market was going down, but eventually a rising tide lifts all boats. It just took it down, right? It had to. I think that this stock is going to be a massive, massive winner. And whenever we can get some relief, and this did exactly what it did. It shook people out, it came back, found support at the 50-day moving average. If this pops today, I say grab it. And you can just, if you want to, you can trail the 5-day moving average very close, the 20-day moving average. You don't have to let it come all the way back down here. I think these moving averages that are hard to see, the green line and the peak line, if it pops, I think that's where you put it. Now, just one more key lesson to kind of farm these lists. If your lists, and again, by the way, these are just ideas. These are ideas. You make your own decision, but don't ever, ever buy something without a hard stop, especially right now. If you buy something without a hard stop, you're asking for it. But, how to kind of farm these lists. If you have a couple really bad days in the market, and let's just say you have a couple stocks that are really, really showing some weakness, like, down 8-9%, just delete them from the list. Get rid of them. Why are you wanting to buy those, right? We are focusing on relative strength, not relative weakness. So just slowly, scan your list for the strongest ones and the weakest ones. If you're noticing multiple days where a stock is showing weakness, get rid of it.